Welcome to FX Signal Team. Today, we are going to start 13th chapter of Part 2. The main topic of this chapter is trading psychology, mastering the emotions of trading. Let's start. A great trading method will be useless without mastering your own emotions and learning about market psychology. As we discussed in the last chapter, you cannot trade successfully if you don't have the 3 M's intact: mind, money, and method. It doesn't matter if you are a very skilled price action trader, if you don't understand how your mindset affects your trading and how it can get you into trouble, you will never make money in the market. You have to make a conscious effort to control your mindset as you trade, so that you don't make stupid decisions like trading when there's no setup present or risking too much on a trade. If you don't make a conscious effort to understand and control your mind and your emotions as you trade, the market will chew you up and spit you out faster than you can imagine. Fear. There can be due to the fear of losing money, the fear of being wrong, the fear of the unknown, the fear of missing out, and the fear of leaving money on the table. There can immobilize a trader and lead to inaction. It can drive out knowledge. There can be managed by learning to manage emotions and small fears. Try to remain unruffled and centered. Be able to accept consecutive losses without replacing your method. Winning traders take positive action despite their fear. Protect your capital with stop losses. Each and every trade does not have to be a winner. You must be prepared to accept financial risk for an outcome that you have no control over. If you want to be a consistently successful trader, trading is a probability game and nothing is certain. Don't try to pick the winning trades instead of accepting the losses that come with the methodology you are using. If you have 5 losing trades in a row, you must put the next trade on. All methods have some losses, and you are not a loser because your trade is a loser. Remain non-judgmental about yourself. Each time you feel you have done something wrong, mistakes will happen. No one is a perfect trader, so don't beat yourself up if you make a mistake. Any money lost is the cost of doing business for a trader. Don't say "I should be trading better," or "I should have caught that move," or "I should have already made X dollars this year." Don't listen to negative thoughts. Focus on what you are trying to achieve. Test your method and refine it, so you know what makes more money than it loses over time. Trade only with money you can afford to lose and set realistic goals. Don't try to make some unrealistic amount of money in your first year. Trade in a calm and an emotionally unattached state of mind. Know what you are good at and what you are not good at. Greed. Aggressive traders will enter too many trades or stay in trades too long, and the trade will turn against them. There is no need to become greedy in a trade, as another good trade opportunity will be along very soon. Don't try to have one big trade that will make you wealthy. When traders get greedy, they may not even be aware of it. It often manifests as looking at your open profit on a trade and thinking about how much you have made and about how much more you could make by keeping the trade open. Here's the danger with this line of thinking: open profit is just that, open, and you have not secured any profit from a trade until the position is closed. Unless you have closed a profitable position out, you really have nothing but the potential for profit. Traders often confuse the feeling that they get by looking at their open profit on a trade as real money that they already have in the bank, ignoring the fact that open profit is much different than secured profit is the root because of why traders do things like move their original profit target further away as pry, which typically results in a much smaller profit than their original target would have brought them, or no profit at all. If you are too greedy in trading, it has the ironic effect of making profits harder to obtain. If you had a predefined profit target set at a 1-2 or 1-3 risk-reward ratio, but as price gets close to that target you move it further away, because you think price will keep going for an even bigger gain. That is greed, and it will almost always result in you making less than you would have if you just exited at your predetermined profit target. It can be difficult to exit a trade when it looks good and is in your favor, but most of the time, that is precisely when you should be exiting. Many traders hold trades too long, move their targets further out, or set unrealistically large profit targets. All of these things are the result of greed, and they will all result in you making less money than if you were not greedy. Hope and expectations. Hope is essentially the expectation that something will happen or a strong desire for it to happen. When traders trade with too much hope, they often hope themselves right out of making money. Hope can cause traders to move their stop losses further away or delete them altogether, because they hope the market will turn around in their favor, allowing them to avoid the losing trade. Hope works in tandem with greed. When traders hope for an unrealistically large profit and move profit targets further out, this typically ends up with the trader taking a very small profit, because they never take the profit when it's at a decent dollar amount in their favor, because they hope it will keep going and going. Traders also often hope that a losing trade will turn back in their favor. This becomes dangerous when it results in them moving stop losses further away from their initial placement, or not trading with stop losses at all. This is how trading accounts get blown out quickly. Hoping that every trade you take will be a winner is foolish. When a trader hopes for a winning trade, they are also expecting a favorable outcome, and this sets them up for a whole host of emotional trading errors. Because when you expect something to happen and it doesn't, it typically makes you sad, angry, or regretful. It is much better to simply take a realistic view on every trade, and that means understanding that whilst you might have an effective trading strategy, that does not mean every trade will be a winner. You will have a randomly distributed mixture of winners and losers, and hopefully, over time, if you manage your money properly and do not overtrade, you will see the edge that your trading strategy gives you pay off. Thus, it would make far more sense to hope for a profitable trading year if you follow your strategy and implement consistent discipline in your money management, rather than hoping that every trade is a winner. Because then you are hoping for something that is not realistic. Overconfidence. An overconfident trader might trade too frequently or take on too much risk for too little reward. Get to know how successful a pattern has been in the past. Don't go with a hunch and jump in without thinking or doing your homework. Euphoria is the feeling you can do no wrong. Since trading is a game of probabilities, traders will experience times when they can do no wrong, but these times are temporary. The danger is that a trader will take one risk too many and end up with a huge loss. You have to be just as careful after a winning trade as you are after a losing trade. In fact, most traders do well in the early going, but they get overconfident and careless. Their perception of risk in the market lessens after a few winners, so they do stupid things like risk too much and overtrade. This causes them to give back all profits and usually more, and starts a cycle of emotional trading that results in account blowouts typically. You have to remain disciplined, even in the face of the feelings you will inevitably experience after a winner or losing trade. This is really the key to all trading success: persistent discipline. Stick to your method. Stick to your predetermined risk amount. Do not increase arbitrarily. I recommend stick with the same $1 risk amount per trade until you have doubled your account or even tripled it. Many traders make the huge mistake of significantly increasing their per-trade risk after their first winner or two, and they are not yet ready to emotionally handle that level of risk yet. Confidence. There's a big and important difference between real or good confidence and the overconfidence, or arrogance or carelessness that we discussed above. Successful traders build up real confidence by using their method again and again, until they know how successful their method is. This means sticking with their method and not over-trading or risking too much, even in the face of the emotions and feelings that will come their way following a trade. You get to the point of having real trading confidence by following your method and sticking to your trading plan over a long enough period of time, even in the face of the constant adversity the market throws at you. Once you begin to develop real trading confidence, you will be well on your way to consistently profitable and even full-time trading. Inability to pull the trigger. If you are a currency trader, you want to be paid for the time and effort you put into trading. You have to be in the market to make money. You have to make a decision quickly or the trade will pass by, or you will enter the trade when price is retracing or near the end of the move. Put the trades on swiftly and decisively. Don't procrastinate or overanalyze. There will always be some doubt in your mind. That is the nature of trading. Follow your trading plan. Control your emotions. Do not trade with built-in excuses for failing. Preparation and understanding is required. Develop good trading habits. Wait until the trade setup becomes clear before taking action. If you use mental stops for exits, you must take action there too. Exiting a trade prematurely. Some traders bail out of a good trade as soon as it starts to retrace slightly. Later, price moves in the direction they picked. This is very frustrating. Successful traders let their profits run to their targets. Price zigzags. Retracements are expected. Price does not go straight up or straight down for very long. Some traders will exit a trade as soon as they are up by 5 pips. 10 pips, etc. They could have banked a lot of pips if they allowed the trade to travel to their chosen target. Many successful and experienced traders place a trade with a stop loss and a limit order to take a profit at a certain level, and then they walk away from the chart and watch TV or go for a walk so the trade has a chance to develop without interference by the trader. Interfering in your trades, when there's no logic-based or price action-based reason to do so, will drive you crazy. Resist the temptation to do so. Remain disciplined. Stick to your plans and give your trades a chance to play out. Judgment. Eventually, traders will develop good judgment and intuition from their experience. Therefore, don't give up. Your trading will improve with time and persistence. Screen time and good gut feel develop your abilities over time. Checklist. By using a checklist or trading plan, you will not overlook a setup or pattern you should have noticed. Your trading checklist will also give you more confidence, the more you stick to it and remain disciplined. the more it will reinforce positive trading habits into your mindset. Eventually, having persistent discipline to stick to your strategy and trading plan will rewire your brain and make you into a habitually patient and disciplined trader. This is necessary for consistent trading success. Working at your craft. You have got to love finding the patterns, discovering the patterns, and researching. Most good traders love the game for itself. Getting paid for it is a bonus. For successful traders, trading is fun and their rules are executed flawlessly. Discipline. A trader must pull the trigger when an entry signal appears on the chart and calculate the stop-loss point. If there is no signal, the trader must not place a trade. Don't deviate from your methodology once you start. Trade your method over and over again to exploit the edge. Repetition builds your skills. Discipline determines a trader's commitment to following trading rules, handling emotions, and sticking to money management rules. The Forex market will pay you well for discipline. Commitment. A trader should have a passion to succeed in trading and enjoy it. Be willing to do whatever is necessary to achieve your goal. Commitment will ensure that the trader can go through the occasional losing streak and trade profitably after it. Successful traders are highly committed, disciplined, and ambitious people. Focus. Try to avoid interruptions from friends and relatives. Do not try to learn more systems and entry methods. You must stick to what you have and concentrate. All traders feel a natural urge to want more, to keep searching. They lose money and they believe they have made a mistake. This kind of thinking is very wrong. Surfing the internet too much, reading too many books, doubting what you are doing, are all clear signs you lack focus. Patience. One of the biggest discoveries that really helped me become a successful trader was that I didn't have to trade a lot to make a decent monthly return. Most of us consider a 6% annual return very good for a savings account, and if you average 12% a year on your retirement fund, you are pretty happy. So why is it that most traders expect to make 100% a month or some other unrealistic return? What's wrong with making 5 or 10% a month? That's still exceptional over the course of 1 year. Whilst I cannot imply you will make a certain percentage per month, if you just understand that slower and more consistent gains are the way to long-term success in the markets, you will be far better off at the end of each trading year. Here are some other points to consider about patience. By learning to trade on the daily chart time frames first, you will naturally take a bigger picture approach to the markets, and you will avoid most of the temptation to overtrade that the lower time frames induce. Beginning traders especially need to slow down and learn to trade off the daily charts first. Daily charts provide the most relevant and practical view of the market. You do not have to trade every day to make a solid return each month. I consider myself a sniper of the market. I wait and I wait and I wait, sometimes for days or even 1 week without trading. Then when I see a price action set up, that triggers my "this one is a no-brainer" alarm. I pull the trigger with zero emotion. I am always fully prepared to lose the money I have risked on any one trade, because I do not trade unless I am 100% confident that my price action trading edge is present. To really hammer home The power of patience in developing the proper trading mindset. You need to understand that being patient will work to instill positive trading habits within you. Patience reinforces positive trading habits, whereas emotional trading reinforces negative ones. Once you begin to trade patiently, you will see how using your bullets wisely works. You only need a few good trades a month to make a respectable return in the markets. After you achieve this via patience, you will learn to enjoy not being in the markets, because it's then that you are hunting your prey. This in contrast to the frazzled and frustrated trader, who is staying up all night staring at the charts like a trading zombie, who just will not accept that they need to trade less often. Consistency. Keep trading simple and follow rules so you can make money on a consistent basis. Profits will vary from week to week, and yes, you will have some losing weeks or months. Try to be on the sidelines rather than in the market as much as possible. Wait patiently for setups. Set your trades up and walk away for a while. Being consistent is about bringing every attribute of successful trading together and implementing it day in, day out. Conclusion. This is not the end, this the beginning. From here, the real work begins. Coming back to this chapter on trading psychology to periodically review it is a very good idea. Don't ignore trading psychology, it's something you can really never study or learn about enough. Because it really does take near constant reminders about the importance of trading psychology and how it can affect your trading to not let it affect you too much and cause you to blow out your account. Remember, we are speculating on price changes in the market with our hard-earned money on the line, so you cannot help but get emotional sometimes, even if you're managing your risk properly. The only way to counteract the negative effects this emotion can bring is to make a conscious effort to do so. I promise you, it won't happen on its own. Our next chapter will be on conclusion, tips and final thoughts.